our collection of assets and platforms, creative capabilities, and unique place in the cultural zeitgeist give me great confidence that we will continue to define entertainment for the next 100 years. To carry through on that promise, we will be guided by 3 strategic pillars: storytelling excellence, innovation, and audience focus. Storytelling excellence is of course dependent on having excellent storytellers. I am thrilled to share that our legacy of being home to the most accomplished leaders in the industry will continue, as nearly all of our top creative executives have recently renewed, extended, or signed new contracts. I could not be more excited to continue working with these creative powerhouses. Going forward, integrating more owned general entertainment into our services, especially Disney Plus, will be a priority. Our success at Disney Plus this quarter was not the result of any one item, but instead a combination of organic growth and powerful new content. Our strategic decision to include the Disney bundle with all Hulu Live subscriptions and new market launches. The remainder of this fiscal year will feature compelling Disney Plus originals from across our brands and franchises, beginning with Pixar's Turning Red and Marvel Studios' Moon Knight in March. And the back half of FY22 will feature a truly stunning array of content, including 2 Star Wars series, Andor and the highly anticipated Obi-Wan Kenobi, which I am excited to announce will premiere on May 25th. We'll debut 2 Marvel series, Ms. Marvel and She-Hulk. Fresh new shorts from Disney Animation and Pixar featuring the worlds of Big Hero 6 and Cars. A live-action reimagining of the Disney classic Pinocchio, starring Tom Hanks as Geppetto, and one of the most anticipated sequels in some time, especially in the Chapek household, Hocus Pocus 2. As I've said before, we continue to manage our services for the long term and maintain confidence in our guidance of 230 to 260 million total paid Disney Plus subscribers globally by the end of fiscal 2024. I want to reiterate that we continue to see value in the movie-going experience, especially for big franchise blockbusters. We are looking forward to kicking off our summer slate with another Marvel franchise film, Doctor Strange in the Multiverse of Madness. That said, audiences will be our North Star as we determine how our content is distributed. From new franchise-based lands and attractions to craveable food and beverage offerings to must-have character merchandise, there's more great Disney storytelling infused into every aspect of a visit to our parks than ever before. I am personally looking forward to Star Wars Galactic Star Cruiser at Walt Disney World, a 2-night adventure into the most immersive Star Wars story ever created. We are pleased with demand for this premium groundbreaking experience, which will welcome guests starting on March 1st.
First quarter operating income decreased by more than $600 million versus the prior year, as revenue growth across our lines of business was more than offset by higher programming and production costs. Revenue growth in the quarter was primarily driven by increased subscription fees from our direct-to-consumer services. At direct-to-consumer, first quarter operating results decreased by $127 million year over year, driven by higher losses at Disney Plus and ESPN Plus. Operating losses at Disney Plus increased versus the prior year, as growth in subscription revenue was more than offset by higher programming, technology, and marketing costs. We ended the quarter with nearly 130 million global paid Disney Plus subscribers, reflecting over 11 million net additions from Q4. Taking a look at subscriber growth by region, we added 4.1 million paid domestic Disney Plus subscribers, including a benefit of approximately 2 million incremental subscribers from our strategic decision to include Disney Plus and ESPN Plus as part of a Hulu Live subscription. In international markets excluding Disney Plus Hotstar, we added 5.1 million paid subscribers, primarily driven by growth in Asia Pacific and European markets. Finally, we were able to resume growth in Disney Plus Hotstar markets with 2.6 million paid subscriber additions in the quarter. Moving on to content sales, licensing, and other, results decreased in the first quarter versus the prior year to an operating loss of $98 million. While theaters have generally reopened, we are still experiencing a prolonged recovery in theatrical exhibitions.
The vast majority of the signups that came this quarter came from the Combo Plus, In other words, it's the bundle. And so we're starting to see LATAM sort of pick up some of the same characteristics that we see in domestic.
We expect for the full year spend on content to be, including sports rights, to be as much as that $33 billion in total. And this also assumes there's no significant production delays. And things can happen for things other than COVID as well. We had a couple of productions that did get delayed for other reasons. But when you think about your comment on our heavy slate of content coming to the service in the fourth quarter is true, but remember the spending for that is before then. You'll continue to see increased spending this year, and when you're looking at that $33 billion, I think it's also informative to take into account that about a third of that is for sports rights, including the programming and production, but primarily it's the sports rights. So if you want to think about the total $33 billion, take out a third for sports, and the remainder is for content. Not all on Disney Plus, some of that's for Hulu as well.
Please like, subscribe, and comment on the video. May the Force be with you.
Impressive. The most impressive.